You're scrolling through your favorite shopping app at 2 a.m., probably buying something you don't actually need, when suddenly you see that magical buy now, pay later button staring back at you.
My name is Tim Cook. I'm the CEO of Apple.
What's the difference?
I'm really excited to share with you all our latest feature, Buy Now, Pay Later from Apple Wallet.
So, like a credit card?
We're calling it Buy Now, Pay Later, or BNPL. Then I'm calling it Tim App. You can take out loans from $50 to $1,000.
You click it, get approved in seconds without any paperwork or awkward phone calls to your bank, and boom, you just took out a loan without ever leaving the app. That's embedded finance doing its thing, and it's basically the financial equivalent of having a bank teller hiding inside your smartphone.
Buy Now, Pay Later was used by millions without governance.
Ready to help whenever you need money stuff done. What's wild is this isn't some futuristic concept we're talking about here. This is happening right now, today, probably in an app sitting on your phone as you read this. Embedded finance is essentially when companies that aren't banks decide to offer banking services directly inside their own platforms. Kind of like how your corner store started selling lottery tickets and money orders, except way more sophisticated and happening entirely in the digital world. Instead of redirecting you to some clunky bank website that looks like it was designed in 2005, these apps use something called APIs, which are basically like secret handshakes between different computer systems that let them talk to each other and share information instantly. The magic happens because while you're focused on buying those concert tickets or ordering food, the app is having a lightning-fast conversation with actual banks in the background, handling all the boring regulatory stuff and money movement while you just see a smooth, simple experience that doesn't make you want to throw your phone across the room. What makes this whole thing so brilliant is that it taps into something we all understand on a deep level, which is that nobody actually wants to deal with their bank unless they absolutely have to. We live in an age where waiting more than 3 seconds for a web page to load feels like torture. So the idea of switching between multiple apps just to complete a simple transaction feels almost prehistoric, which is why embedded finance is growing faster than a teenager's TikTok following, with market projections showing growth from around $115.8 billion in 2024 to potentially $386 billion by 2030, which represents a compound annual growth rate of over 36% that would make even the most successful YouTuber jealous. The whole ecosystem works like a perfectly choreographed dance between 3 main players. First, you have the sponsor banks, which are the actual licensed financial institutions that handle all the heavy lifting when it comes to regulations, compliance, and the boring but crucial stuff like making sure your money doesn't disappear into the digital void. These banks are like the responsible adults at a house party, making sure everyone follows the rules while the fun stuff happens around them. Second, you have the banking as a service providers, or BaaS platforms, which act like the middleman translators between the traditional banking world and the tech-savvy app developers who probably think FDIC insurance is some kind of new cryptocurrency. These BaaS companies take all the complex banking infrastructure and package it into digestible, plug-and-play modules that app developers can integrate without needing to understand the mind-numbing complexities of financial regulations or risk management. Third, you have the actual brands and platforms that customers interact with daily. Companies like Shopify, Uber, Walmart, or whatever app you use to procrastinate when you should be working. And these companies are the ones who get to play the hero by offering seamless financial services that make their users' lives easier while secretly building deeper customer loyalty and creating new revenue streams. If you're seeing how apps are becoming banks, hit that subscribe button. I promise I won't ask for your PIN. More fintech deep dives are coming. AI banking, open APIs, meme stocks. It's wild. Stay in the loop. When JP Chase announced their partnership with Walmart to bring embedded finance solutions to marketplace sellers.
You started at Walmart when you were 18 unloading trucks. What was it like back then?
Those trucks were hot. It was summertime and there was a lot of heat and we worked hard in those trailers and hard picking orders. And I was surprised at the associates that I was working around in the warehouse and how happy they were.
It wasn't just another corporate press release that most people ignore. It was a signal that this embedded finance revolution had reached the big leagues. JP Morgan's Leah Cao, head of embedded finance and solutions, explained that their platform allows clients to accept, manage, and send funds all within the same ecosystem.
Credit costs have normalized, so it's just almost back to what I call a normal environment. Whether it gets better or worse from here, I don't know, but kind of normal.
What makes this partnership particularly interesting is that Walmart's marketplace has over 700 million items from 100,000 sellers. And in the fourth quarter of 2024 alone, they saw a 40% surge in marketplace sales, which means thousands of small business owners can now handle their entire payment lifecycle without ever leaving the Walmart seller dashboard. JP Morgan isn't stopping there either, as Kao mentioned that they now have embedded finance partnerships with more than 20 clients and expect that number to double over the next year. Beyond the big corporate partnerships, embedded finance is showing up in places that might surprise you. Take ride-sharing apps like Lyft, which can now offer their drivers instant access to debit cards that are automatically loaded with earnings from completed rides, eliminating the traditional wait time for payments and giving drivers immediate access to their money when they need it most. This isn't just convenient, it's potentially life-changing for drivers who live paycheck to paycheck and can't afford to wait several days for their earnings to clear through traditional banking systems. Similarly, e-commerce platforms like Shopify have expanded beyond just helping people build online stores to offering business checking accounts, lending services, and payment processing all within the same dashboard, where merchants already manage their inventory and customer relationships. Insurance is another area where embedded finance is creating interesting opportunities, with companies like Tesla exploring the possibility of offering auto insurance policies that are tailored to individual driving data collected from their vehicles, creating a seamless experience where buying a car, financing it, and ensuring it could all happen through the same interface. The numbers behind this growth are absolutely mind-blowing and paint a picture of an industry that's moving from experimental to essential at breakneck speed. Market research firms are projecting that the embedded finance market will experience compound annual growth rates of over 30% through the rest of this decade, with some estimates suggesting the total addressable market could reach $7.2 trillion globally by 2030, which would make embedded finance larger than the entire GDP of most countries. North America is currently leading this charge, contributing more than 33% of the revenue share in 2024, but Asia Pacific is emerging as the fastest growing region, which makes sense given the mobile-first nature of many Asian economies and their willingness to adopt new financial technologies faster than traditional Western markets. The embedded payment segment alone is showing tremendous traction, with businesses discovering that when they make it easier for customers to pay, those customers tend to spend more money and come back more frequently, creating a virtuous cycle that benefits both the platform and the end users. The convenience factor driving embedded finance adoption goes way beyond just making payments easier. It's fundamentally changing how people think about and interact with money in their daily lives. When you can get a loan while buying concert tickets, set up a savings account inside your freelancing app, or purchase insurance during an online checkout process, the traditional barriers between different financial services start to disappear, creating a more fluid and intuitive relationship with money that feels natural rather than bureaucratic. The app jumping phenomenon that embedded finance eliminates was creating genuine friction in people's lives, forcing them to remember multiple login credentials, navigate different user interfaces, and manually transfer information between platforms, all of which created opportunities for people to abandon transactions or choose simpler alternatives. By removing these friction points, embedded finance solutions are not just making existing processes easier, they're enabling entirely new types of financial behavior, like micro-investments triggered by everyday purchases, automatic savings programs tied to spending patterns, or instant insurance coverage for high-value purchases. However, this convenience revolution comes with some serious considerations that are not always highlighted in the marketing materials and success stories. Privacy concerns are becoming increasingly complex as embedded finance solutions require extensive data sharing between multiple parties, creating situations where your spending habits, financial capacity, and personal information are being analyzed and stored by companies that may not have the same level of regulatory oversight as traditional banks. When you use a buy now, pay later service embedded in a shopping app, that transaction data is potentially being shared between the retailer, the payment processor, the lending partner, the credit reporting agencies, and possibly other third-party services that help with fraud detection or marketing optimization, creating a web of data relationships that most consumers don't fully understand. Security is another major consideration because embedded finance solutions often involve multiple integration points and data handoffs between different systems, creating more potential vulnerability points than traditional banking relationships, where your financial data stays within a single, heavily regulated institution. Regulatory oversight is struggling to keep pace with these innovations, creating situations where embedded finance providers might be operating in gray areas where the rules haven't been clearly established yet, which could potentially leave consumers with less protection than they would have with traditional banking relationships. The competitive landscape implications are fascinating because they're creating both new opportunities and new risks for businesses across multiple industries. Companies that successfully integrate financial services into their platforms are discovering that they can significantly increase customer lifetime value and reduce churn rates because users become more deeply integrated into their ecosystem, making it harder and more inconvenient to switch to competitors. This creates a powerful network effect where the more financial services a platform offers, the more valuable it becomes to users, and the more users it attracts, the more attractive it becomes to financial service partners. However, this same dynamic creates risks for businesses that fail to adopt embedded finance solutions quickly enough, because they may find themselves at a significant competitive disadvantage when customers start expecting seamless financial integration as a standard feature rather than a nice-to-have bonus. The super app concept that has been successful in markets like China is starting to emerge in Western markets through embedded finance, with platforms potentially becoming one-stop destinations for everything from commerce and entertainment to banking and insurance. Looking toward the future, embedded finance appears to be just the beginning of a broader transformation in how financial services are delivered and consumed. The concept of invisible finance is gaining traction, where financial services become so seamlessly integrated into daily activities that users barely notice they're interacting with banking services at all. Similar to how most people don't think about the complex telecommunications infrastructure that makes their smartphones work. Artificial intelligence is enabling more sophisticated real-time decision-making around lending, insurance pricing, and fraud detection, making it possible to offer personalized financial products that adapt instantly to changing circumstances, rather than relying on static applications and approval processes. Open banking regulations in various countries are creating opportunities for even more innovative financial integrations, by requiring traditional banks to share customer data with authorized third parties through APIs, potentially leading to a world where your financial information can seamlessly flow between different services and platforms based on your preferences and needs.